the accounting class. In this session we take our last look at corporations. If we hold stock, then it is probable that we are hoping for dividends to be paid to give us a return on our investment. Cash dividends are the most common form of dividend and the reason why most folks do invest. However, they are not the only form of dividend. Sometimes a board will declare a dividend to be paid in stock. This does not provide the stockholder with any cash. Occasionally a dividend is declared to be paid as a promissory note. This means a promise to give the stockholder something in future for their investment. Dividends are usually paid pro rata. It's important to understand what this means. It relates to the share that you hold and the share that you can expect to receive. So in plain language, what does that amount to? The amount of cash that you receive will be in proportion to the amount of stock that you hold. If you hold 30% of the stock, you get 30% of the dividend. If the total dividend is $1,000, then you get $300. Where do I start looking to find out how much dividend different corporations are paying? If you have the time, then you can look at the financial statements. You will find details in the statement of owner's equity. Most of the large corporations have financial reports that can be viewed online. Try searching with Yahoo or Google. The newspapers are also likely to report the results for larger corporations such as Microsoft or Apple. What sort of things should you look for? The way that a dividend is reported is common for corporations. If it is a cash dividend, it is usually reported as a dollar amount per share. This makes it easy to compare one corporation with another. If you want cash dividends, you should understand though how that system works. Remember that distribution is by pro rata. So let's just recall that. If you own 30% of the shares, you get 30% of the dividend. So every year I'm going to get a dividend. Well, no, not necessarily. It doesn't always work like that. First, the corporation must have done sufficiently well for a dividend to be declared. There must be retained earnings after taxes have been paid. The retained earnings can have accumulated from previous years. In most of the states there are other rules. A corporation cannot use paid-in capital to pay a dividend in most states in the USA. You should think about why most states do prohibit this. Even if there is a large sum available as retained earnings, it will not mean an automatic declaration of a dividend. Just because there's a large figure in the accounts for retained earnings does not mean there will be a large figure in the cash account. It is possible the figure in cash is very low and retained earnings have been invested in plant, equipment and property. Finally, the board has to agree that a dividend can be paid. If the board plans further investment, then it may decide against declaring a dividend. There can be pressure on the board. Some investors do look for corporations that pay good dividends. So do the earnings justify paying a dividend? Retained earnings may be high, but what about earnings for the year that's just ended? If the dividend is declared, how will it be entered into the accounting system? There are usually two entries that can be made because the declaration and payment of a dividend do not occur at the same time. The declaration will be made for the end of year accounts, but the next year will almost certainly be underway when the payment is made. This means that the first entry, which is the declaration, will record a liability to pay the dividend at a future date. The retained earnings account will be debited. This reduces the retained earnings by the amount to be paid out as a dividend. The second part of this entry will be to record the liability to pay that dividend. So at this point we have a liability account called dividends payable. Since the dividend will be paid in the course of the next financial year, it is regarded as a current liability. In the example shown, the date of declaration is the last day of the financial and calendar year, December the 31st. The second double entry is then made to record payment to the stockholders. At this point, we debit dividends payable, this removes the liability, and we credit cash to make the payment to the stockholders. When the declaration is made, stockholders' equity is reduced. When the payment is made, the assets are reduced. These are the two effects on the business. Now let's consider stock dividends. The declaration of stock to stockholders is very different to giving them cash. Retained earnings decreases and the paid-in capital increases. There is no alteration in stockholders' equity. It might appear that there is little more than juggling with the figures, and some people think this is in fact the case. Let's look at this in a quick case study. A stock dividend is declared. You have 10 shares with par value of $10, so $100 altogether. When the extra shares are issued, this is what happens. But the amount of stock in terms of your share of the total stock has not altered. What are the entries here for the accounting system? Consider what happens to the statement of stockholders' equity. The total of stockholders' equity is $3,000 made up of retained earnings and common stock. Afterwards, the total stockholders' equity remains the same, but there has been a redistribution. We can see the figure for retained earnings has been reduced, whilst there is a new figure to be paid for paid-in capital in excess of par. Splitting stock is different. Additional shares are issued to the stockholders. The amount is based on the type of split and the amount of shares originally held. The effect will be to reduce the par value of shares. A brief case study will illustrate this. A 2-for-1 split will double the number of shares and will halve their par value. Payment of dividends will affect retained earnings. Retained earnings are also a part of the stockholder's claim on the business, just as net profit after tax was for a proprietor. However, the book value of the common stock will not alter when retained earnings alters. Having retained earnings is not the same as having cash. Retained earnings can increase at the end of the year, but the increase could represent additional investment rather than more cash in the bank. If the corporation makes a loss, this will affect retained earnings, just as making a net profit after tax affects retained earnings. Paid-in capital remains the same even if the corporation makes a loss. If the loss is too great, then retained earnings may have a deficit. In other words, it will show a debit figure in the accounts. You should note that the charter of a company can place certain restrictions on the way in which retained earnings are used. A board of directors can also be given powers to do this. If this is the case, then the law provides that such restrictions are made known as notes in the financial statements. This ends our last session on corporations. Thank you for watching and listening.